Hello everyone, in this video we're going to be talking about how do I choose what futures contract to trade. Now we know futures have so many products over many different sort of industries and asset classes. For example, you have the most popular futures contract, the S&P 500 mini, which is an financial index. You have the US Treasury bond, which is an interest rate product. You have things like crude oil, which is, of course, a commodity. You have gold, which is a precious metal. You have things like corn, which is an agricultural product, and so on and so forth. So when you're beginning to trade futures, you need to make a choice of, okay, which product do I choose to trade? And so today we're going to get into some of the considerations necessary to make that decision. The first variable has to do with what is the nature of the product that you're trading and how does that align with your particular style in terms of your risk tolerance as well as your account size. What do I mean by your risk tolerance and then secondarily your account size? Well, each product has different what are known as contract specifications, i.e. the value that will be transferred into or out of your account based on how much the price of that particular product moves. Let's give you a very clear example. We're going to use three examples today. We're going to use gold, we're going to use crude oil, and we're also going to use the ES, the S&P 500. Let's start off with the ES. On the right hand side here, you can see I have a chart of the ESH, which is the March contract expiration for the ES, the S&P 500. And you can see that in terms of the price movement, we have what is known as 4 ticks, i.e. price increments, that make up 1 point. What does that mean, Shane? If you see 38.33, to get from 38.33, 1 point down to 38.32, you must move to 32, 38.32.75, 38.32.50, 38.32.25, and then 38.32. So what that means is the S&P 500 moves in tick increments. 1 tick of movement either adds or subtracts $12.50 from your account. So one movement up or down is $12.50 in profit or loss in your account. Now, why is this important? Because you need to find out by way of observation, by way of research, typically how many ticks or how many points does the S&P 500 move based on your particular time frame. So whether you are a day trader, you are a swing trader, you are comfortable on very short time frames, or you're comfortable on intermediate time frames like the hourly or the 4 hourly, or are you more comfortable on time frames like um, the daily and the weekly? So you need to do some research in terms of how much can you expect by way of price movement in your particular product, and then align that with, okay, am I comfortable having this much price exposure in my account? Again, that is going to be based on your own personal risk tolerance as well as the size of your account. So if we were talking about gold, for example, we have a chart here, a depth of market on gold here on the extreme right of the ES chart. And you can see instead for gold, each point is made up of 10 ticks. So to go from 1858 to 1857, you go through 1857.1, point 2, point 3, point 4, point 5, and so on. And each of those ticks is worth $10 in price movement. So every tick that gold moves up or down is $10 in price movement. So that means a 1 point move in gold equates to $100 of price movement. Let's use a very simple example. If we look at this price bar here this is a 30-minute price bar. Let's say the high of this range was at around 1862 and the low was just about 1856. So that's 6 points of price movement. 6 points of $100 per point. So $600 of price movement has taken place in just the last half an hour on gold. That is a fairly volatile move. If you have a smaller account, let's say uh, $3,000 or $5,000, then a $600 move as a percentage of your account is a very large amount. So you would love to have the ability to expose yourself to the upside of that move. However, that also means exposing yourself to the possible downside of that move based on the volatility, based on how much the product moves in terms of its natural variation. So there is no outsized catalyst, there is no news announcement, there is nothing that is pushing market participants quickly one way or the other. In the absence of a catalyst, in the normal gyration, ebb and flow of this product, this is the type of movement that you can get in a very short space of time. So you need to ask yourself, am I comfortable with that? Have I flexed my risk muscles enough to be comfortable with that sort of price movement? Do I want to go for something that's a bit more conservative? Do I want to go for something that may be even more volatile than that, depending again on your risk tolerance and your account size? And the last example we'll use is CL, which is crude oil. As you can see here, crude oil has 1 cent increments, 1 cent increments, 52, 22, 23, 24, 25, etc., etc. And 1 point or $1 on crude oil, $1 move in crude oil equates to $1,000 of price movement. $1,000 of price movement. So that means every tick that we move from 48 to 49 or 48 to 47, every tick that we move is $10 of price movement. And again, let's just look at this chart here. Again, this is a 30-minute chart. Let's just look at one of these bars, what seems to be an average bar. Let's take this red bar right here. We have a low at around 52.30. We have a high at around 52, let's call it 55. So you have a 25-cent price movement from the low to the high, representing approximately $250 of price exposure. Again, you would love to avail yourself of the upside of that move, and some people are completely comfortable availing themselves with the upside of that move or the downside of that move, again consistent with the size of your account. If you have $100,000 account, then a $250 move does not even make you blink an eye, again within the normal gyrations and ebb and flow of this product of crude oil. However, if you have a $2,000 account, then a $250 move is more than 10% of your account, can either possibly make or break your day, your week, your month, depending again on your risk tolerance and the objectives that you may have set for yourself. So the first consideration is know the price ranges and know um, the nature in terms of volatility of your product, and make sure to align that with your personal risk tolerance so that you're not feeling emotionally compromised when you have to make decisions. You want to make decisions based on what the market is telling you, to stay in sync with the movement of the market, versus making an emotional decision because you're watching either the type of exposure or price exposure you have in your account P&L. The second variable that we have to think about when it comes to choosing the type of futures contract that we want to trade is how much size of that contract can we trade in our account based on the margin that it takes to trade that contract. For example, on the ES, we'll use the ES as the example for this one. On the ES, most brokers, there are typically three types of margin. There is the initial margin, which you must have if you wish to hold a position overnight. There is maintenance margin, the margin that you need in order to open and hold a position open during the day session. And then there's what is called day margin, which is set by your individual broker, in terms of what you need in your account in order to open a position in that particular product. For the ES, that is, most day margins are typically between $400 to $500 to open one contract of the ES. So let's say, for example, you have an account that has $5,000 in it. You could prospectively trade up to 10 ES contracts. However, based on what we were just speaking about, you may conclude that, and I would definitely advise that you conclude that that is simply too large. In fact, one ES contract with the typical movement of the ES between 16 to around 30 points per day of movement, given the fact that the ES is $50 per point, you are looking at 750 to almost $1,500 of price movement with one contract. So there's no real need to really size up on the ES in terms of going over two or three contracts on any account that is less than $10,000, because of how much price opportunity it offers you. So definitely how much margin your broker is requiring of you to trade a particular contract is also of extreme importance when it comes to choosing which product to begin getting your feet wet and begin getting mastery and sophistication over. It is incredibly important to pair the understanding of contracts volatility, its tick or point value, as well as the amount of leverage, i.e., the margin you require in order to trade a contract, in order to make an informed decision as to which product or products you are going to trade that are best aligned and resonate with your personal style, your trading philosophy, and where you feel comfortable in terms of your trading process. Okay, guys, we'll leave it there. Thank you so much.